So I'll quickly set the agenda for the audience watching. Just to set some context, today, along with these two guests, we'll be discussing some key questions like what is fractionalization? It's a heavy word. People might not understand it, but it is so crucial and is so basic in how it helps the overall economy. So we'll discuss that. What are some of the benefits of fractionalization as well? How is it impacting the property market as well right now? How is it impacting the corporate debt market as well? What steps or what new innovations Grip and Strata are also taking right now? And why does it benefit the retail investors altogether? So these are some of the key questions that we'll be answering via this webinar. I want to start with you. Fundamental question: what is fractionalization, or what does fractionalization of financial assets even mean?
Yeah. Thanks, Yash. Once again, pleasure to be on the webinar. Just diving straight into your question, fractionalization for anyone who's studied fourth or fifth grade maths is dividing something into smaller pieces, and every financial asset over a period of its life has got divided. For the
Hmm.
simple reason that if you have a large ticket size, a large investment value, say 10 lakh rupees or 1 crore rupees, it becomes impossible for majority of people to invest in it. Fractionalization is the ability to convert that same investment opportunity into small pieces, could be as small as 100 rupees, so that more people can invest.
Hmm.
Ultimately, the underlying asset is still worth the same 1 crore 10 lakhs, but it just now is available in smaller units.
Hmm.
Many of us don't think of the stock market as fractionalization, but the stock market is the most classical and successful form of fractionalization for financial assets.
Hmm.
Imagine a company like Reliance, which is worth hundreds of billions of dollars. If only there was no fractionalization, only one person could have owned all of the company. But the ability to convert it into shares that any of us could invest, and I think the share price is around maybe around 2-3 thousand rupees today, at invest at that ticket size makes that fractionalization possible. The same
Hmm.
is true now for other financial assets, increasing the types of investments a retail investor can do.
Hmm. Okay, got it. So, I mean, what apart from, let's say, getting access to assets which people couldn't get before, do you think there are any other benefits from an overall portfolio perspective of fractionalization?
Yeah, maybe I can take that and Sudarshan can add. So I think the biggest advantage is really diversification.
Hmm.
The ability to access multiple assets at small ticket sizes allows investors to now build a more diversified, a more wholesome portfolio, deploy strategies that may be more attuned to their risk rewards, to their age, at the same time reduce the risk from having over allocation to any single asset class. I think it also allows people to begin exploring new assets that are coming to the market, which they may not have previously done, and to begin that exploration by investing small amounts of money. So I think those are the two big advantages from an investor point of view.
Okay. Sudarshan, anything to add there?
No, so echoing exactly what Nikhil mentioned, that more than that, we talk only from a investor standpoint also. Let me give you a perspective of the seller standpoint also.
Hmm.
For let's say Mukesh Ambani, for him to figure out how to liquidate hundreds of billions of dollars, it's impossible for him to do it. So fractionalization is important for him also because he's getting several stakeholders to be part of it. First, who can keep adding value. We've seen multiple movies where we've seen, lakhs of people coming for his AGMs, etc. People come, give ideas, give thought processes, etc. And we also, when we were building Strata, we also felt the importance of community in some sense, right? That, okay, the same investor who's buying a property is also working somewhere, whose company is also going to require office space or a warehousing space or a industrial space, etc. And why don't we be the right partners for them? Vis-a-vis them going to top developers, etc., also, right? So, a community investment is how I look at it when I talk about fractionalization in general. Gives even a seller as well as a buyer both benefits for them. Buyer, Nikhil has already touched upon whether it's diversification or getting access to a asset class which was never accessible to him at the first place. And at the same time, for seller also, especially for a country like India, if you want to keep uh, scaling up and keep growing, you'll have to keep democratizing and fractionalizing every asset class possible. Otherwise, there's
Mm,
no way you could really scale up because, in China, there's this concept of community buying altogether as well, which allows everybody in the community to get a better pricing of the product or what your Sumitomos of the world did in or Kiritsu as it called did in Japan for that matter, where they were doing wholesale buying and giving benefit to all the all the industrial buyers especially during the World War times, etc. So I think that is the other side of the business which people tend to forget, that if that doesn't happen, then really you cannot scale up the nation the way you can think of.
mm. Okay, fair enough. Thank you, Sudarshan. So I want to come to my next question, and I think you've partly answered that question, that why do we need fractionalization both from the seller and the buyer's perspective. But Strata works in the real estate space. Indians naturally love real estate, love owning a piece of home, property, makan, shop. You know, that famous saying goes, roti, kapda, makan. Makan is still the most important factor there. Why are you fractionalizing real estate, and why now? Why is it happening
So, two, three parameters, right? Let's take US, China as two best examples who have really grown up, and if we are on the same trajectory to be those kind of trillions of dollars of economy, fractionalization was the only way, these guys kept scaled up. Like wheat penetration in US is about 90-95%, which is very, very high vis-a-vis in India, which is
now?
very, very low comparatively. So hence, from that standpoint, this is a time, in my view, especially with access to digital platforms being available, access to information and knowledge. Erstwhile, I don't know how many of, probably both of you or even the viewers who are watching, that you could know the same price at which you bought an apartment and what price your neighbor bought an apartment. You had no idea. When you go ask a neighbor, हाँ मैंने भी 10,000 rupees per square feet में खरीदा, but no one's gonna tell you the exact price in general, right? I think over the period of years, especially in India now, in the last 3-4 years especially, a lot of access to information, transparency, and bunch of other things have also started happening, right? So a lot of trust has started getting into different asset classes in general, which was earlier first not there. Second was lack of awareness also to some extent. So now that this is being available, real estate is the most darling asset class to most of the investors in general. I think everybody has 60-70% of their portfolio, parked into real estate assets. So we just wanted to do something better for them, at least from startup standpoint. And the need for commercialization was significantly very, very high. Look at India today. If you see, very interesting and sad at the same time. Most of the large buildings in the country are owned either by your Canadian pension funds or the funds from US or Singapore at max. These three predominantly own almost 20-30% of India, in some sense, the grade A office space, or probably 30-40% or 50% of Bangalore itself, in some sense, right? So, point is that uh, fractionalization is required because we can also participate into such kind of growth stories, get access to such kind of buildings, which erstwhile was not available. And if you see even the regulator standpoint, whether it is promoting InvITs, promoting SDIs, promoting all these newer products, it is only to ensure that the more fractionalization happens, more concentration of wealth, which is with 1%, gets disseminated to multiple people, etc. also at the same time, right? So the need for real estate is even more today if India is going on the similar trajectory of China, let's say from a growth story standpoint, and we are a quasi in America and a China together, we are a services economy plus we want to be a manufacturing economy over a period of time. There's so much money which needs to be pumped into real estate to build those infrastructure, whether it's road for one side of things and other infrastructure, and other ones is your real estate, whether it's your industrial facilities, office spaces, hospitals, and social infrastructure. So there's so much which needs to be done. You can't rely only on 5 or 10, 20 institutions across the world or in India to put that kind of money. The idea has to be that can we get more money into it so that we can accelerate the growth process and hit that target which we want at the same time. So the need of VR is even more, and hence you see even the government and the regulators being very pro that we want to financialize everything. We want to democratize each and every asset class as much as possible so that more money keeps coming in rather than money being parked in FDs. which is what unfortunately Indians have been doing all these years.
Got it. Okay. Uh, Quick follow-up question. Who's the ideal investing audience for these kind of opportunities then?
See, so my view is twofold. As such, the first is for people who are young, probably equities are best for you. But once you cross 35, maybe it's something for you to start putting diversifying in general. And I'm hoping when they're 35, at least they have their home. So the whole roti makra kapda makan story continues, and I don't think so we can change that because it's engraved into our genes significantly. If, even if you want to, probably your parents will force you to do it as well. I've had instances where people are not getting married if they don't have their houses also,
Yeah.
etc. So that's a sad or a good truth, whatever it is for that matter. Perhaps in a good way, that's the only way our generation can even consider saving in a large way.
For
Otherwise,
a
we
home.
tend to
Yeah.
blow up significantly as such. But typically, 35 to 60 is a good age of audience who should ideally look at investing because you should look at start diversifying into safer asset classes also. And more importantly, just diversify your portfolio rather than have a concentration portfolio. Beyond 60,
Mhm.
obviously, we go through our own NISM certificate. So we know beyond 60, the ratio should be more debt, less equity, etc. And hence, from that parameter is different. And I hope with time, the reverse mortgage stories also start coming for elderly people so that there's cash flows coming to them from the real estate and they can cash out that as well. But predominantly, that is the age group as such. So somebody who has their own home already, instead of buying a second home, should look at diversifying across these different asset classes available to them.
Got it. Okay. Nikhil, now fractionalization is only possible, let's say, via digitalization. I mean, without digital platforms like yourselves or other tons of platforms, or even the digital infrastructure available, the UPI or the exchanges, DMATs, fractionalization is kind of not possible, right? I mean, what do you think about
Yeah, you're right, and one of the reasons why we have seen so many fractionalization or so much fractionalization happen, and so many platforms like Strata, like Grip, and others come, is because that financial infrastructure is now existing, and we are actually able to leverage it. The when you fractionalize something to 1,000 rupees or even a lakh of rupees, the cost of distribution and
it?
management is very challenging without the access of digital infrastructure. Imagine you are someone who wants to invest 1,000 rupees in a corporate bond, or in Strata's case 10 lakh rupees. How will you? The cost of execution will be more
Hmm.
than the actual investment or the returns made. In Strata's case, there will be stamp paper, there will be, you want to see the asset. All of that has to be enabled digitally. In the bonds case, how do we make sure we've got your bank account details, make sure you've done your KYC from a regulatory perspective, pass you information. So I think for all of those things, digital infrastructure is very important. I would,
Hmm.
I think I'll speak on behalf of Sudarshan to say we're just fortunate to be building in a time in India when digital infrastructure is so robust,
Yeah.
especially on the fintech side, and getting better by the day. And we are able to take advantage of it, whether it's payments, whether it is materialization, whether it is escrow, whether it is transaction, online agreement signing, online KYC. We're fortunate to have that happen.
Hmm. Perfect. No, makes sense. Uh, I want to get into a bit of corporate debt segment right now, and then move on to property or SM REITs, which is much more, uh, getting excited. But recently SEBI reduced the face value of privately placed corporate bonds from 1 lakh rupees to 10,000 rupees, Nikhil. First, can you talk about the difference between a publicly placed bond and a privately placed bond? Because a lot of our viewers and community members still say, "अरे 1,000 रुपए का bond तो available है ना? So what is 10,000 rupees a big deal?" So first we want to talk about that, and then second is why does this 10,000 rupee bond really matter, and why did SEBI make that move?
Yeah, no, I think that's a great question and super important. In the next few months, we will see many of these bonds come to the market for the first time, and understanding it is important. Both the differences and the advantages. So, I'll draw comparisons to the equity market because it comes easy to explain.
Yeah.
If you recently saw the Ola Electric IPO, that was a public issue of Ola Electric shares. Same way, if a company issues corporate bonds through a public IPO similar to Ola Electric, then that is a publicly issued corporate bond. Before the IPO, Ola Electric issued shares to SoftBank to Matrix through a private process.
Hmm.
The same way, if a company issues bonds to individual investors or institutional investors through a private process, it is called a privately placed bond. Okay. So if you look at the equity market, it's the same way with respect to the debt market or the bond market. Um, Both of these products, I think it's important to understand, are regulated by SEBI, whether it is publicly issued or privately issued. Both of these products need to be rated by an independent rating agency like a CRISIL Care. So, to some extent, to protect investors, provide them information, there's a safeguard created which is common. And both of these shares also have to be held in demat account, right? So, a lot of the attributes are similar. Now comes to the real point of difference and why 10,000 rupee face value for a privately issued bond is so important. Most companies who go public, who do public bond IPOs, are the largest companies. They are, for
Hmm.
example, recently the Motilal Oswals or Navi Finserv, Ugrow Capital, Bank, or the government companies, right? HDFC Bank, etc. These companies typically are AAA rated or AA rated, and hence the bonds they offer are normally in the range of 8 to 10% in terms of yield. So while you have the 1,000 rupee bond, it's the AAA rated 8 to 10% yield. As retail investors, one of the things we have seen is that individual investors are looking for higher returns. They're looking for 12 to 13% returns. This is typically available only in privately placed bonds. It is not available in publicly placed bonds. So 10,000 rupees face value will for the first time bring a 12 to 13%, maybe even a 14% return bond available to investors at a very small ticket size, with the advantage of it being regulated, rated, held in your demat account, right? And all the other advantages of bonds, which is it's a fixed income instrument. So that is why it's such a big game changer for investors. I think one more point to add, and I should have talked about this earlier when you talked about advantages of fractionalization, is that fractionalization creates liquidity. Okay?
Hmm.
Until you have many buyers or many holders, you
Yeah.
cannot have transactions happen. Right? People will not sell, or you place an order but will not sell. With retail investors participating in fractional amounts, there will be more interest to buy and sell. And hence, liquidity will develop in the market. Ultimately, it will mean that if you're looking to exit your investment ahead of time, you will be able to find a buyer. So that's
Hmm.
another big unlock that will happen because of the 10,000 rupee face value bond.
Yeah. No, perfect. Makes sense. Sudarshan, coming to you on the property side, SEBI has come in and brought the SM REIT regulation to regulate the fractional real estate space altogether. They have reduced the ticket size, I think. I mean, the minimum investment size is 10 lakh rupees. Strata was doing 25 lakhs for all its deals, as far as I am aware. Uh, Apart from the reduction in ticket size, how do you think the SM REIT regulation all together will impact your segment?
So multiple things which are very positive right now. First, the fact that SEBI thought this is worthy regulating as a sector altogether. I remember in my early conversations, people are like, no, 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 it's going to take at least 10 years before this is going to come. It came within fourth year of our operations as such. So definitely something. I hope we are instrumental, even if 1% for that matter. We're very proud that there's a new regulation in the country, like how Nikhil's been driving, because of which bonds have been regularized in some sense and democratized in a larger sense, is the way to move forward. That's what we felt has happened. Like I said, so giving access to investors was more critical. Now that the ticket size is further reduced and what we hear from the regulator, it's a gliding path. They'll bring it down to maybe 10,000 rupees the way it is for the corporate bonds today. It is going to be a game changer because that way a lot of liquidity, more awareness will also start coming into it. But from an impact standpoint, what I foresee is two very, very large game changer things which can happen over a period of time. First, you don't have to run after only limited pools of capital, which I was mentioning to you earlier. Now there is other pools of capital also available for a seller, and he can get better value for his investment, or in general, a lot of the money could probably be retained in the country and not go out of the country. That is number one. Second, which is very large over a period of time, is in some sense, financialization of all the real estate in the country, which is now going to move to the stock market, in some sense, if you see, which is right now privately held. So when it moves there, a lot more traction there, a lot more corporate governance will become better. I think in a way, people treat real estate as a dirty asset class or it's too gray, etc. I think this regulation is a step towards making it more cleaner, more accessible, better corporate governance, and bunch of other things which gets attached to it, with the regulations around it, right? So that is a thing which we are very proud of, in general, especially the fact that regulator thought about regulating this space. Additionally, just to add on, like when I'm touching this word financialization multiple times, it's an opportunity for a lot of asset owners to look at I mean, to look at just liquidating or um, probably selling some part of their asset portfolio as well, right? I mean, we have asset owners today who we bought assets from. These are, let's say, one of the persons we bought is was a chairman of a large bank. Two daughters, he's about 75, 80 today. Two daughters, both in the US and Germany. They're like, hey, I can't expect my daughters to come and review these 60, 70 page lease agreements, work with multiple brokers to find a tenant, etc. I'll happily come and financialize my investment with you. I'll sell the investment, but I'll continue. I'll buy 25% back or a 50% back, whatever is permissible, as such, and accordingly, the rest, let the balance be owned by by retail investors. So how people did IPO for their companies, I think people can now do IPO for their buildings, as such. Today, the regulation says 25% is the maximum you can own. Maybe with period of time, it goes up to 75%, for that matter, right? Like, so go after PSUs, go after hospitals, go after these kind of asset classes who would be very keen to say, okay, you know what, I want to continue owning, but I don't want to, but I would like to sell some, and probably put everything in a more financial rather than a real estate investment. I'll make it into a financial asset. Multiple benefits, also for a seller in general. Advantages where he can take a lap, which is what he used to do earlier, pay all kind of mortgage charges, and it's a circus to take a loan in the country today, to be very honest, especially related to real estate. And if it's commercial, it's even more because you have to review lease agreements and bunch of other things. Now that it's financialized, it's available on the stock market. Like an OD facility, you can take money, give money back, etc., and continue operating. Get yourself rated at max. Advantage to leverage will be better. Today, real estate gives you a lap of maybe 60% tops. Labs can give you about 80, 85% also depending upon the rating which you have, etc. Right? So, a lot of advantages we foresee in this sector in general over a period of time, and for investors to more importantly get something which they can say, okay, it's verified, checked, regulated, it's on the stock market for them to invest blindly and start allocating. So, one of our larger visions is that today when we talk about that, there should be gold in everyone's portfolio, there should be this in everyone's portfolio, that in everyone's portfolio. I'm hoping tomorrow over a period of time, even SM REIT should be part of everyone's portfolio over a period of time.
Got it. Okay. Uh, I think there are a couple of questions also coming in right now, but can you also talk about the difference between an SM REIT and a normal REIT, which is already available on the stock market for much more lower ticket size, much more fractionalized as well?
See, it's taken time for SEBI also to regulate. They started with 2 lakhs, then they brought it down to 50,000, and then they reduced the ticket size to 300, 400 rupees, whatever the share price is of each. I think that's going to be the gliding path even for the SM REITs. The regulator has been very vocal about it as well. That we'll want the asset class to just stabilize a little bit and then go in this thing. I don't want a situation because we're going to do an IPO for every building. We've had questions in the past that, oh, I'll probably invest only for IPO gains and exit. This is not that kind of an asset class for one to consider. It's about, it's real estate investment, just that it has a financial angle to it, or a color to it, but end of the day, it's a real estate owning in general, right? So, but adding to, from a question standpoint, what is the difference? See, SM REIT is going to be more specified, focused investment into one asset class or one asset with one kind of tenant in one micro market vis-a-vis a REIT which has multiple properties across. So in a more simple analogy, it is you buying an HDFC stock directly vis-a-vis buying a mutual fund who's also going to buy an HDFC stock. So it's not going to be a big delta or a difference per se. Just that you have more control, so you know the property you bought via the FM REIT, via the scheme, which asset you bought, who's the tenant, what is the return going to be, what is the micro market trends going to be there, etc. Vis-a-vis in a larger REIT where there are hotels, there are solar assets, there are under construction assets, there are completed assets, there are vacant assets, you get blended return of everything put together, right? So two different products, very difficult to compare in general, but at least that is going to be the core difference. Returns can be a little better here and there, honestly. So you really can't compare that as well, that which is better, which is not. It's only over a period of time we'll realize what is better and what is not, because it's too early to comment right now on that. But at least from that standpoint, we foresee that the SM REITs could be little better comparatively than a REIT, purely because there are no other asset costs, there are no under construction assets, there are no hotel assets which have its own cyclical demand, etc. And accordingly you can invest into something more specified, more focused, more aware. Maybe you can go see the property, etc. I mean, I don't know, Yash, if you're a REIT investor per se. Let's say if I talk about Embassy REIT, do you know who are the tenants of the buildings? What are the buildings they own? Who's paying what rent? What is the market rent of the property versus the rent you're obtaining? Is the property tax being paid by the REIT entity or not? So there's so much which is there. It's so I just treat SM REIT as just another alternative to you directly buying a real estate, knowing everything about the real estate and then investing into it. But from a return standpoint, if that's what most of the investors would want to know, I think it's net not going to be a big delta. Maybe some 50 basis point to 100 basis point, that can be a marginal difference where the SM REIT can be beneficial vis-a-vis the larger REITs today.
Okay. 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 Thank you, Sudarshan. Uh, Nikhil, it's a wild card question just came to my mind. So, from your perspective, of course, we're talking about corporate bonds and property right now. What other assets in India do you think have the scope for fractionalization? I mean, putting you on the spot there, but yeah, if you or Sudarshan, anyone, something jumps to your mind, let me know.
So I think my view is that every asset should be
Hmm.
fractionalized. Okay.
Hmm.
Okay.
The degree of fractionalization can be decided, and Sudarshan uses word called gliding, which is you can start by fractionalizing it to a few lakhs, even a crore, but it's still fractionalizing, and then over a period of time reduce the ticket size for investment. Okay.
Hmm.
Just if you dial back history, road assets till maybe 2015-16 could not be fractionalized. But then
Hmm.
the InvIT structure came and allowed you
Hmm.
to actually, as retail investors, own a national highway. All right,
Hmm.
you can go back to doing shares. So there are constantly real assets, or maybe even sometimes financial assets, but that can be brought over a period of time into fractionalization.
Hmm.
I think some of them may be more riskier than others, and
Hmm.
hence you can choose to have a higher ticket size. Let's take a slightly exotic example, an MF Hussain painting. Okay,
Hmm.
I can pretty much assure that no one on this call can afford to buy an MF Hussain painting on their own,
Hmm.
but should at some point of time it be possible to own a unit which represents a fractional holding of an MF Hussain painting, right? And
Hmm.
if it appreciates in value, we can all make money. The MF Hussain painting can be displayed in a national gallery. You can go and admire the painting that you are part owner of, and if it
Hmm.
gets sold, you can do it. But art is a very different concept. It's risky, so maybe you should not fractionalize it to a few thousand rupees or lakhs of rupees. It may require a higher ticket size. The principle being fractionalization is important. I think it really is the ability to move the market, move the economy in the right
Hmm.
direction. And I would not like to curb any asset that can brought into fractionalization.
Hmm. No, so the example of art and or example of real estate or corporate bonds, these are all appreciating assets in to some extent, right? What if I want to fractionalize a car and give it to 10 people? What if I want to fractionalize a yacht and give it to maybe 200 people? Would these kind of concepts make sense for India? Sudarshan, what do you think? I mean,
No, so I'm a for believer. Whatever Nikhil mentioned, fractionalization is the only way every asset class should go through. There are uh, platforms who fractionalize private jets, and it is important because unless you're an Elon Musk who travels every day, you need to keep running those beasts, otherwise they fall sick. As a better word to speak it, but that's the way, right? So cars, for that matter, is another way. Supercars are the way. Arts, what they mentioned, there's a very large company in the US called Masterworks, which does this fantastically well and is able to monetize and generate revenues as well because they are now lended to museums and they get regular rental returns out of those artworks as well. But having said that, there's a very interesting company called Rally Road in the US, which I haven't seen in India per se. It's RALLYRD, which fractionalizes memorabilia, those very limited edition sneakers, limited edition cars, limited edition Rolex watches, whatever it is for that matter, and gives investors an opportunity to invest into something. I mean, watches are a great example. You've seen how they appreciate as well, or cars maybe not appreciate, or even these comic books which are limited editions. You hear suddenly right on an eBay the first iPhone which is still unboxed got sold for, let's say, $50,000 or $1 lakh, etc. Those kind of asset classes also are something which India hasn't seen. Maybe with time there might be something interesting for something like that to come in. But for any asset class to go broader, Nikhil made this very important point, is liquidity, right? So unless you're not able to create that kind of liquidity over a period of time, which means unless you cannot go deeper into it, which means more buyers and sellers have to be interested in this asset class, only then you can go deeper and try to make these, whether it's artworks or memorabilia or all these things for that matter, a reality in some sense.
I'll just add, Yash, because at Grip we have fractionalized ownership of cars as well,
Yeah.
and plant and machinery. I think whether it's an appreciating or depreciating asset, both assets have their own form of returns, right? So if it's an
Hmm.
appreciating asset, you'll have capital gains. But if it's a depreciating asset, typically you will have interest income or lease income.
Hmm.
And as long as those that return is attractive to the risk you're taking, it is very possible to fractionalize. So we have done,
Hmm.
lots of cars which now run on Uber's platform, and they
Hmm.
generate 13-14% returns. For the kind of risk you're taking, it becomes attractive to do, even if it's a depreciating
Hmm.
asset.
Hmm.
And
Well,
the biggest
Nick,
example
yeah.
is airplanes get leased all the time. That's the only way Indigo
Hmm.
flies. So
Yeah.
Yeah. Yeah. Fair enough. Nikhil, the leasing model that you just mentioned, you have leased out cars. That was via the SDI structure, right?
that's right.
And can you also talk about how you are, let's say, pooling different other types of assets, maybe loans or invoices, and putting into SDI, and then allowing them to fractionalize? Because, I mean, to give an example, let's say, an invoice discounting transaction might be, the invoices might be 3-4 crore rupees, but you guys are, let's say, putting all those invoices into one pool and then fractionalizing that pool, right? And can you just talk about
Yeah.
that, how it works?
Sure. Maybe two steps back, while SEBI encourages fractionalization, it always puts measures in place to protect the investor.
Sure.
So, one of the things that they have done is when they talk about fractionalization, is ideally encouraging a pool of assets to be clubbed together rather than a single asset. Okay.
Hmm.
And the second thing they encourage is that you must use instruments that SEBI authorizes. You cannot use
Hmm.
unregulated instruments. Yash, in your point, for example, invoice discounting, the way it is done, where you have a single invoice being offered to
Hmm.
people, is an unregulated instrument, which
Hmm.
does not allow you diversification either. Uh, SDI is a SEBI instrument, and it solves for this purpose. Very simply, it creates a pool of thousands of invoices, thousands of loans, lease assets, and whatever is the cash flow from it, revenue, interest, lease payment, those cash flows are then assigned to investors.
Hmm.
There are several other security measures put in place, but as an investor, when you buy a unit, you effectively get all those cash flows to yourself. So that's the concept of an STI.
Okay, got it. Thank you. Sudarshan, we were talking about SM REITs, putting you on the spot. When do you expect your first SM REIT to be out?
So we made our application. We're waiting for the license, to be very honest. There are
Uh-huh.
several, and I'm hoping by first week or second week of September we should have that and we should move forward. But from a first listing standpoint, there are several other things which the regulators and us are still working on, right? On what are the checks and balances to be there, what should be the listing process, how can we expedite the listing process? Because currently the listing process is close to about 60 to 90 days, which is very, very large comparatively. As such. So there are a bunch of things which is going to work on, but very tentatively to do. I think by end of this financial year, you might see two or three listings as such, or by end of this calendar year, maybe you'll see your first SM REIT listing, which can happen. Many would have realized, okay, why are you not doing anything until then? Is because SEBI would not allow us to migrate those assets, which would not be, barring few which we are requesting for exemption, and they've been very kind, because these are already pre-committed, and we now just can't not do and lose the momentum of a business because the idea is to grow the industry and not scuttle the industry down. Barring two, three which we're going to do or have done, the idea is that they are not going to allow us to migrate anything which is done after the regulations came in and not play with the regulation rules as such, right? So yeah, so that's the thing. And maybe hopefully around that, I think SEBI has been trying to encourage more and more people to also apply for licenses and get into this because, like I said,
Mm.
more people coming, the depth of the industry grows, bigger, more awareness is happening for this kind of an asset class, etc. So we are hopeful that there should be 5, 10 people at least in the next 1, 2 years who are running this because they are professionally managed. Developers cannot run SM REITs as such, so
Yeah.
it's not going to be that an embassy is selling its own embassy stock and you're buying it as such. Here it can be a neutral where we are going to put our 5% money as well. So that way our skin in the game is aligned and we cannot exit for 20 years almost. There's a downward trajectory in which we can reduce our holding, but we cannot exit these investments forever. So there's so much alignment in every angle possible from the regulator standpoint to protect the investor standpoint. So yeah, so we are hopeful more and more people come in and this industry becomes very large over here.
Mm. Okay, exciting. Very exciting for the investors, particularly. Nikhil, 10,000 rupee corporate bond. Any timeline that you'd like to give to the investors watching this? And when are you launching that?
Yeah, first of all, to Sudarshan, the process that he's going through today is exactly what we went through last year. So I have, at the same time, when the OBPP regulation came, so I have both sympathy for him, but also I can tell him that it's very rewarding to go through that journey
Yeah.
and benefit from regulation. It will, it'll cost the business 4 5 months, but it'll pay off. And I think it'll benefit the investors tremendously, which is ultimately all of our objective. I think because for us things are now at a good hum. I can Yash give you maybe a more exact timeline. So we've actually uh, on Monday we will actually create the first 10,000 rupee corporate bond. We are hoping that this will be the first, to the best of our information, the first corporate bond ever in India to be at 10,000 rupee face value. It takes about 1 week to complete the listing formalities, and it will be available on Grip's platform in the following week. So around 25th, 26th of August. It's an exciting corporate bond. It's like I said, it will allow investors to make the 13 14% returns even at a 10,000 rupee ticket size with all the comforts of a regulation, credit rated demat instrument. But yeah. So we're about a week to 10 days away from it being offered.
Wow, very exciting. I mean, I'm so happy you said it here first and not via your regular communication.
Yeah, I don't think my marketing team will be very happy, but you can.
Great. Just last question to you, both gentlemen, because we have a lot of questions coming in. In the West, particularly in US, there's a concept called mortgage-backed securities, which is a form of SDI and a form of real estate. It's a combination of both. Yeah, it's basically a pool of houses clubbed together, uh, where those houses are mortgaged to a particular bank. Bank will, give them onto a SPV and then create a SDI like instrument and give it out to the investor. Do you guys think there is scope for that kind of instrument for retail investors in India? I'm asking for retail investors because I know in the institutional level, a lot of these players have already done that, the housing finance companies, but we have never seen instruments like these in the public domain for retail investors. So do you think you guys will maybe in the future work together to create instruments like this? Sudarshan, what do you think? Oh, you're on mute, Sudarshan. Sorry, you're on mute.
Maybe Nikhil can start because he's an expert in packaging and democratizing debt and every kind of instrument. Maybe Nikhil can add and then I can add on.
Sure.
So,
Nikhil?
I think the very simple answer is yes. I
Hmm.
think there are MBS or mortgage-backed securities is the largest uh, form of SDI that are today done in the institutional market in India.
Mhm.
Um, at GRIP, we have done one SDI which has loans against properties. So in a
Yeah.
way, that was an exposure to real estate, but not a true MBS security. I think we would be very excited to do one alongside Strata and bring an MBS product where there's commercial assets and the loan or lease against those are securitized. Yes, there are two challenges that come from an investor appetite perspective. Number one is typically MBAs tend to be very long term because real
Sure.
estate as an asset class is a long term asset class, right? You can't do a 2 year loan or a 3 year loan. You have to do a 10, 15,
Right.
20 year loan. So investors need to be ready to take a long term exposure. Number two is that because the security is so good, it's real estate, the returns tend to be lower, right? They tend to be
Sure.
8, 9%, maybe even lower returns on the asset class, especially because they're pooled instruments, very high security cover. So as long as investor appetite is there for a longer term, lower return product, but very secure product, I think there's a room for an MBS. Without that, it may be a little bit more challenging for it to be offered. I think in that case, it will be more on the nature of LAP loans, which are higher yield that we can offer.
Okay. Okay.
So just to add on, yes,
Sudarshan, anything to
Yeah, Nikhil and I have been talking about it for the longest. We've been wanting to do
add?
an experiment, if not for anything, a smaller one, maybe a crore for that matter, just to see how this goes out. But the challenge which Nikhil and I have faced is predominantly the return, because
Hmm.
these are high quality assets, super secured, and and unfortunately there's a bank who's also competing for a product of this nature, in some
Yeah.
sense. The idea is that how do we make it more lucrative and competitive to investors? Unfortunately, the environment at which we are in today, people making in equities are making 20-30% every month. So, an 8-9%, if you talk on a year-on-year basis, not going to be an exciting proposition, maybe later with time, etc. But that is the plan of action. We've been working, we've spoken multiple times. Sooner or later, we should have our first product of that nature.
Mhm. No, very exciting times for retail investors in India. I just want to summarize my key takeaways from this discussion is that there are ample of benefits of fractionalization. It's a trivial concept. People might just ignore the concept altogether. It's so trivial, but it has encouraged affordability by reducing the ticket size or the barrier to entry. Be that via SM REITs, be that via 10,000 rupee corporate bond, be that via mutual fund units. So regular retail investors can enter into the market or enter into the financial market much more easily. It has helped diversify the portfolios as well. And in turn, it has, also increased the liquidity in the market, which is very, very challenging in certain asset classes. The viewer should be aware that it's much more easier to sell, let's say, a 10 lakh rupee portfolio of a real estate rather than 6 crore building altogether. It's much more easier that way. Or same on the other side of corporate bonds. If I'm holding a 10 lakh rupee corporate bond, there might be very less takers for that 10 lakh rupee corporate bond. But when it comes down to 10,000 rupees, voila, why not just go ahead? So yeah, those are the benefits of fractionalization. Uh, People should, I mean, I consider myself very fortunate to be born in this generation where we can invest in any sort of assets, thanks to SEBI, thanks to guys like you as well. Would like to thank you both, Nikhil and Sudarshan, for sharing your thoughts with the wider audience. For the audience, if you like this webinar, don't forget to like and share this video. I think a lot of key concepts or key questions have also been answered on this webinar, which will be beneficial for your friends and family who are very much interested in investing in, let's say, property or corporate bonds, or even understanding the general concept of fractionalization.